what to do in a down market. A down market like this provides lots of opportunities to make money, especially for an options trader. I have some ideas for you and what you should do in a down market to make some money coming up next.
When I close my eyes, I can almost see it. When I take a breath, you fill up my lungs. And if my mind worked backwards just for a minute, I'd hold on to you before the memory's gone. I remember you, you lift my spirit. With you high is all I'm feeling. Remember how we felt alive. I remember you, you make me stronger. Can't go without it much longer.
All right, so thanks for the theme music from Serpentenza and ADV China. Awesome YouTube channel, which you should definitely check out at some point. Learning all about China. Anyway, I'm really excited on the heels of that James Cordier video. I have some new subscribers. People are asking me, oh, well, how are you going to keep the momentum going now that you have new subscribers? You should make a video about iPhones and buy a new iPhone and make a video about iPhones, to which I say, the YouTube world doesn't need another video about iPhones. However, they can definitely use videos about options trading because guys like this James Cordier and others create a bad name for options trading, and there's always a need for more education in this subject. So let's talk about a down market. Now, I can't say if we're in a bear market right now. I can't tell the future. I know we're in a correction. I know volatility is cranked a little bit. And if we went back to like a year ago, you could hear all these people complaining, saying, volatility's crushed. There's nothing to do. We just kind of go straight up. And it's just not that great of a situation. It's not a trader's market because volatility is way in and there's just not a lot of opportunity. You can't trade stuff back and forth. Well, that's all changed. And just because the market is not rallying straight up doesn't mean that we can't make money as options traders. That report came out a couple days ago saying all these hedge funds are down money in October as the market's down. And someone had a great point. Why should you buy a hedge fund if it's going to be down when the general market's down and they're just doing the same thing as everybody else does? Getting into a hedge fund that's like going to buy FANG stocks and that's their strategy, you might as well just invest in an index. Hedge funds are supposed to be unique investments that can work in conjunction with just being long the market or traditional investments to possibly either protect your downside or increase your upside. And so a hedge fund whose strategy is to get long the FANG doesn't sound like that great of a strategy to me. And a hedge fund that's down as soon as the market's down big, a lot of people have this strategy of just either always selling out of the money puts or selling out of the money calls. And if we talk about the strategy for that James Cordier guy with natural gas, as far as I understand it, what he was doing was selling way out of the money calls. And these are high probability trades. That meaning that there's a high probability that natural gas is never going to go near that price, and so that that you're going to make money on the trade. The trade's going to be successful. However, with many high probability trades, the downside is that if you do lose, the risk is big. So let's take just a vertical spread, for example. And we could use UVXY for an example. And if we have a very high probability spread in UVXY vertical, like for example, let's take UVXY right now is trading, and this could be any stock really. UVXY is trading 62.80 right now. So if we were to say sell the January way out of the money call vertical. So let's say we sell the January 85 call, and we buy the January 95 call against it, okay? So $10 spread. The most it can be worth is $10. We're selling the spread for 90 cents as it shows on the screen here. I'm kind of in the way of the screen. Let me move over. But it's showing here us the spread right now. You could probably sell it for around 90 cents. That's the midpoint. And so when we look at trades, there's several ways of looking at them. You can attach a volatility number to the trade. You can look at how much you're collecting compared with how much you could lose. You could look at the charts. How far out of the money percentage-wise is this on the charts? And I would suggest trying to look at a trade in as many ways as possible before you execute it. And so, for example, this trade, the Jan 85.95 call vertical to sell it. Now, it's very unlikely that UVXY is going to be above 85 on Jan expiration. It's even more likely, it's even less likely, obviously, that it's going to be above 95 on expiration. And thus, this would seem like a free money trade to sell this spread. However, we want to analyze several things. One thing is how much of your capital is going to be tied up in this trade and for how much and for how long. And in this case, it's a $10 vertical spread. So each time you do it, it's going to lock up essentially $1,000 in buying power minus the money that you collect on it. So in this case, it would probably lock up $910 each time you sell the spread, because the most you can lose is that $10 minus however the $10 between the strikes minus however much you sold the spread for. So in this case, that 90 cents you collect could turn into 810 cents of a loser. So you're basically risking a lot to make a little, and if you do this thousands of times, then the money that you're collecting is small compared with the money you're risking, very small. And even if, and if you're leveraged in some way, even if the spread doesn't get to that price, it can blow up in its value against you. And this is even more obvious if you were just to sell a naked call. So for example, let's look at the naked call situation here. If we were to look at the UVXY Jan 95 call and sell that, okay, it's worth $3. Now, it's very unlikely that this is going to be above 95 on expiration. However, this $3 premium that you're collecting to sell a naked call, you're going to have to put up a bunch of money, and this trade seems like a berry of a trade in that it seems like a free $305. However, the things that can go against you are that you don't have enough capital behind you to absorb the ride until expiration. So, for example, if we do get a spike in UVXY, this $3 in premium can double quite easily without UVXY getting anywhere near 95. And so if you don't have the necessary capital behind you to absorb that storm, you can be forced to cover at really bad prices and possibly blow out your account. So this is a great trade to do in very small size compared with your account. If selling 10 of these calls represents 1% of your buying power, then it's a great trade to do. And because, like I said, the chances are that this goes out above 95 are very, very unlikely. But what we have to measure on this trade, besides the fact that you need to leave a lot of cash sort of on the side to weather the storm, is where could that cash be used more efficiently? Is there a trade that ends in December that has a similar amount of profitability potential to this one, but it ends sooner so that you can reallocate that capital sooner to something else? Also, you've got this call that could blow up in your face. It might make more sense to you to sell a call spread, like I was talking about, maybe the 85-95 spread, make less money, but you know what your downside is, and they've already taken and put in escrow the maximum loss, so that seems a lot safer. Or it might be better to sell a fatter option that's closer to at the money. So, for example, instead of selling that 95 call, you might consider selling a 65 call and buying the 95 call against it. Now that's $3,000 each trade in buying power between the strikes, minus $600. So because $580 in premium, about $600. So it would be about $2,400, a little bit over $2,400 put aside for each time you did this trade. However, you're selling a little bit of you're collecting a little bit more money versus how much you have to put up. So you're collecting $600 versus putting up $2,400, as opposed to collecting $90 for putting up $810 in the other trade. Now, if we were to switch this to 65-75, in this case, it's a $10 spread. You're collecting a little bit over a quarter of the spread up front, and thus, if it blows up in your face, you've already collected a quarter of the premium, which is much better than having only collected a tenth of the premium. So, you need to look at things in this way. When I first started trading UVXY, I said to myself, wow, selling that Jan 95 call is a great trade because there's no way it's going to end up here. But I didn't think in my mind that, like, oh, well, if this even spikes up to 70, this call could double in value, and I need to have enough money on the sidelines to withstand the spike. And, for trades like this, you could do it very small and just have it part of your portfolio. Sell one or two, have it as part of your portfolio. And if you're only short a very small amount, then no matter what happens, you'll be able to weather the storm and you'll collect some money. But you don't want to make it like the biggest part of your P&L, this having some trade like this on, because when you do things like that, they are sure to blow up in your face. It's just kind of like a Murphy's Law type thing. All right, so let's talk about some other ways to make money in a down market. And one way we can do that is we can actually sell puts when we get a big downdraft move in some of these issues and everything is screaming lower. We can sell out of the money puts when volatility gets really cranked. So, for example, we can pick a stock that has a little bit of a higher volatility. I would use Tesla, but Tesla really hasn't been screaming lower, but maybe Tilray, for example. If we pull up Tilray, out of the money puts get pretty cranked up. We've got 56 days to go. The Jan 70 puts are trading 5 bid at 7 basically. So $6 for that Jan 70 put. And that's pretty, it's a decent amount out of the money. That's a lot of money to sell a put for. Even better would be to sell a put spread, because then you're limiting your risk. So if we look at the Jan 70-60 put spread in Tilray, sell that one Jan 70 put, buy one Jan 60 put, and collect a decent amount of premium. If we roll this up a little bit, for example, like what if we were to sell the Jan 85 put and buy the Jan 75 put, Okay, we're collecting almost $4 on a $10 spread. So you're collecting a lot of premium based on versus how much money you have to put up. So, for example, for this spread, if we take a look at how much money we have to put up, you're betting 610 to make 390. So the ratio isn't so huge. It's not like you're having to put up $1,000 to collect 80 or something like that. Because when you do a spread like this, where you're already collecting a decent amount of the distance between the strikes, it can't blow up as much in your face. This spread could a little bit more than double in value, but it's not going to triple or quadruple in value if it goes against you. And that can be comforting to know that stuff isn't going to blow up in your face by 4 or 5 times. If you are selling way out of the money options naked, stuff can blow up in your face big time. If you're selling closer to at the money options and it's in a spread and you're collecting a large amount of premium versus the distance between the strikes, there's less of a chance of it blowing up in your face, and you've already collecting a lot of premium, which is great. Now, as we look at, let's take Tilray for example, as we move out in time, just because of the uncertainty of time, these numbers get more and more kind of wacky. So, for example, we can go out in March. March is 112 days away. If we look at the 60-50 put spread, which is basically like 100% out of the money at this point, you can sell it for almost 50% of the distance between the strikes. So you're almost, you can almost make 100% on the money that you put up for this spread. And if the stock stays around here, this spread is going to rapidly decline in value as just time goes by. You don't have to wait till March for this to decline rapidly in value, because as time goes by, that bell curve of likeliness of the standard deviation, it's going to curve inward pretty rapidly, and these strikes that are way out of the money are going to become less and less worth a lot of money as that time goes by. And when you think about it, it sounds like a good trade, thinking that, well, the 50-60 put spread, when we look at Tilray, it's bounced off of 100 a couple times. So for it to go all the way down to 50 seems very unlikely. And it's not like if it did go near there that you're losing 3, 5, 10 times the amount of money that you put up. You could lose, you could lose 100% if it goes all the way down, but you already have collected 50% of that spread, and the spread is likely to go out worthless. So collecting 50% of the spread's value that you consider worthless seems like a good deal. Now, the problem with a spread like this in March is you are locking your money up for a couple months, 112 days. But to double your money, 112 days doesn't sound bad. And this is something that needs to be monitored, but it doesn't sound bad. The other advantage of selling put spreads has to do, once again, with margin requirements. When we sell downside, like a put spread, in a month, let's say we do sell that put spread. If we were to sell the March 50-60 put spread 2 times, our margin requirements, each time we do that, the margin requirement is going to be $1,000 because there's $10 between the strike minus whatever premium we collect is going to be how much your buying power goes down. But the essential margin requirement is going to be $1,000 each time you sell the spread because there's $10 between the strikes. However, that same $1,000 that you have to put up can also guarantee a trade to the upside. So if you put on a trade that you like to the downside that has some downside risk, remember that you can also, in addition to the leverage that buying power gives you, that $1,000 to the downside, you can sell the same amount of upside against it and essentially turn this trade into a big condor without having to put up any more extra money. So if I sell this 50-60 put spread for around $5 and collect 50% of the distance between these two strikes, and I hang out and Tilray rallies, or even if it doesn't rally, I could look and sell a way out of the money call vertical against it in Tilray. And the reason why the margin requirements are like this and you don't have to put up extra money is because in the end, both things can't happen. It can't go out below 50 and above whatever strike you sell on the call. So only one of these bad things can happen on expiration. So they allow you to guarantee both trades with just that, putting up that one amount of money. So once again, if you sell a put spread and you're required to put up $2,000 because you sold it 2 times, a $10 put spread, then you've got $2,000 to the upside of buying power that you can use to put risk on against it. And therefore, if you sort of leg into using this extra leverage, you can put some great trades on very efficiently as far as the buying power required. One word of warning with this: if you do sell a put spread, and this starts really ripping to the upside, and you've sold your upside, then all of a sudden you can find yourself in trouble. And so you don't automatically want to just sell some risk on the upside just because it seems like you have this sort of free buying power. You want to be strategic in what you do. But I'm very aware now that anytime I sell, and it works the same way with the upside. If you sell a call spread to the upside in an issue, then you've once again got that free ability to sell downside without your buying power increasing. Now you are putting on more risk, but you don't have to put up more money for it. So it's definitely something to keep in mind. In addition, another thing we can do in a down market is, heaven forbid, we can get short some of these issues. If things, if things don't appear to be bouncing all the time, we can lean a little bit short, and we can be strategic in the way we do it. We could sell out of the money calls, or out of the money call spreads, and participate in the down move a little bit. A lot of these issues have moved lower and lower, and they don't appear to be bouncing right back. And thus, selling a little bit of upside can give you some income. And a lot of these markets are moving back and forth very rapidly. So if you put a trade on and it all of a sudden goes your way, like for example, if you sell some puts in a Tilray and the next day it's up $10, you can lock in that profit, take your money, and move on to something else. So look around. I can't tell you which trades to do. The best trades that you're going to do as a trader are going to be the ones that you find yourself. I can give you some ideas about how to think about things. And the way to think about things is to go through lists of stocks. Warren Buffett talked about how he would order annual reports from companies, look at the financials of companies, and find stocks by himself. I encourage you to do that as well. And some of my favorite spots to look are at barchart.com, which I talk about a lot. If you go to barchart.com, there are option screeners, and you can find high volatility options, highest implied volatility. I love to look at these, and I'm looking for stocks that have higher prices than $2 or something. So like I look right here, this OKTA sticks out right away. I've never heard of it before. Also this MDB, a higher price stock with high volatility, sticks out right away for me. And I look at them, I pull them up, and try to figure out what's going on, see if there's an opportunity. Several times it's been a situation where someone's come in to start buying or selling an option, and the people who trade it have gotten run over. They've sold these options, and then people have come to buy more. They've sold more. They sold more. And so you can walk into a situation where everybody is down money already except you, and get in at some very advantageous prices in situations in these issues. But yeah, if we go to highest implied volatility here, we can pull up some issues and maybe get some ideas. Some things to watch for are obviously open interest in option strikes and this sort of thing. But your best ideas for trading are going to come from the strangest places. And that's why it's great to look at other people's videos, check out stuff, and look around, because I can't tell you what to trade. And if you try to trade based on somebody telling you exactly what trade to do, it's not going to work. It just doesn't work that way in the trading world. As far as resources for to learn more about options, I love, and you will have heard of these, I'm sure many of them, but I love Tastytrade. You can pull up Tastytrade on YouTube, and they're going to teach you a lot about options on Tastytrade's videos. There's a lot of free videos up there. And then, of course, Option Alpha is a great one. Here's Tastytrade. Options Insider Network. Option Alpha. I like looking at that. TheoTrade, of course. I've interviewed Dan Kaufman from TheoTrade. Very interesting stuff to check out. I'd recommend that. Oop, there's my video with him. Very interesting stuff on TheoTrade. Don Kaufman's a great guy also to give you ideas about how to think about things in the options markets. And remember, folks, all you have to do is find one or two little ways that you personally can make money. You don't have to become an expert in everything. You don't have to know all about bonds, all about gold, all about commodities, all about marijuana stocks, all about this, all about that. You just need to find one little thing that you kind of start to understand and feel comfortable with, that you can make money on. And maybe what you're doing right now isn't working for you, and maybe you try something else for a little while, and focus in on something different. I know that for many people, the VIX trade hasn't worked for a while, and they sort of look for something else for a little while. Maybe you look at an interesting stock that's a high volatility, like Tesla. Maybe you check out Amazon, which has high premiums in the options. But you're going to have to come up with your own ideas a little bit, and the first way to start is to get out there and start looking at stuff. Pull up your Thinkorswim screen if this is what you use, or whichever option screens you use, and look at some issues. I like looking on, if we go to the watch list section here, we can look at the top 10 percentage gainers each day. Top 10 active NASDAQ, for example. And maybe you come up with some names you haven't heard of. Maybe a lot of them you've heard of before, but you come up with one you haven't heard of. Or you remember one that you'd forgotten. So VICI, I haven't heard of it before. So I pull it up, take a look. Go through my screens. Let's take a look at implied volatility. In Thinkorswim, one of the best places to go is under the Analyze tab and to look at option statistics. This information right here under option statistics is going to be crucial for you. Current IV percentile, that tells you where in the range volatility is right now. And in this one, it's right in the middle, showing HV percentile. That's telling you how much basically the stock is actually moving around. IV, implied volatility, is going to be a measure of options prices. Historical volatility is going to be a measure of how much the stock has been moving around. So if you have high options prices and the stock's not moving around, then selling options is working. If you've got low implied volatility and the stock's moving all over the place, then people who owned options are probably doing okay. check out this stuff. Do a little research by yourself. Get out there, come up with your own ideas. I'm doing trades all the time where like I look and there's like no open interest in the strike. Nobody else is doing that trade, and sometimes it can be hard because of a lack of liquidity. I was doing these trades in the stock RH for a while, and I was the only one doing the trades. Now, if you're the only one doing a trade, you need to, research it and feel confident in yourself enough to do that. It's probably not the first thing you want to do when you start trading options, but you probably, if you're first trading options, you want to deal with a very liquid issue. So maybe like, I don't know, an Apple, a Cisco. Cisco was the first stock I traded as an options trader. I was in the Cisco pit. And the thing with a Cisco is that there's going to be more liquidity in the options. So today is not a perfect example because there was only trading for a few hours today, but you can see there's some liquidity even today in these options here. Well, there's not a whole lot, 330 contracts, but there's something. Let's take a look at Apple here. So Apple, a little bit more liquidity here, 2,000, 3,000 volume, and then open interest figures here that I have set up that I'm looking at. So the market's going down should not be a deterrent to your trading because, like I said, as options traders, we don't need the market to be rallying to make money. And in fact, there is more opportunity created when stuff is moving all over the place. Now I'm going to put my list back to what I had before. People talk a lot about setting up your list of stocks. Now mine's very much centered around the VIX because I trade that a lot. So I've got all my VIX futures here. But my list doesn't look that much different than many other people's in that I've got the major indices here. I've got gold down here. I've got a list of stocks that I'm sort of following. I add some stocks to it and subtract some from time to time. I think it's very important to quote-unquote know what's going on during the day by following the major indices. And the ones that I follow are, I have E-minis, I have the NASDAQ, I have Dow futures, and I have IWM and RUT for Russell, and I have gold here. It's debatable how much gold really plays into things. Most people follow bonds as well. And then the major FANG stocks, I have most of them listed up here as well. Just to kind of give me a feel for what's going on in a particular day. So I don't know. I hope that this is a little bit helpful for you. If you've just found my channel, welcome. I don't have the most polished, always slickest videos ever, but that's not the point here. The point here is to help you make money. Lots of YouTube channels. There's gaming channels, and lots of people get really into gaming. You know what? Trading options is very similar to gaming. A lot of it is very similar. The difference is that you can make a lot of money trading options, whereas gaming, you're giving money to Bethesda or someone like that instead. And it's surprising to me that more people don't trade options. Options, you can put the odds in your favor. So many people, and I know this is like different worlds here, but so many people in my world, my reality outside of like when I walk away from this computer right now, so many people in my world, so many people, a high percentage of people in my world buy scratch tickets with all their spare money. And the odds on scratch tickets are awful. And, when a lot of people will come on financial videos and act like the majority of the population doesn't believe that scratch tickets are going to be their way to their financial success, whereas there is a big gap in education in finance out there. That's why I say we don't need another person dropping the iPhone X off of a skyscraper video. We need more videos on finance. This guy, James Cordier, who was selling out of the money calls in natural gas, he might have had too much size on, and didn't know what he's doing, but he was making a more intelligent trade than buying a scratch ticket. The odds were, probabilities were in his favor of making money. And over, if you take that trade over a long period of time, it would definitely make money. People who are buying scratch tickets or gambling in ways where the odds are against them all the time are going to lose money all the time. And to break people out of that mindset, I think there's this mystique that they have a chance of making money. Well, we want to have more than a chance of making money. We want the odds on our side that we are going to make money. And then once we have the odds on our side, we want to put on a lot of trades, because as the number of trades we put on goes towards infinity, when the odds are in favor, our actual results will begin to approximate more and more the actual odds. So you've heard this before from Tasty Trade, from Don Kaufman, from all kinds of people. We put on, from Kirk at Options Alpha, we put on high probability trades, and we put on a lot of them, and altogether they will make money as long as you manage your size and you spread them widely enough. Thanks for watching today. I hope I gave you something to think about. Feel free to reach out to me. I appreciate all the new viewers. Please consider clicking on the links below for my sponsor, Gorilla Trades. They have a great track record of picking stocks and can make it easy for you to make money. And also, feel free to check out and to give $1 for my Patreon. I'd love to get that message that says that you signed up and we're willing to give $5 towards this channel, help us grow. I've got all kinds of ideas for content here, and I just need help to keep it growing. So thanks for everybody's support. If you just found me on the other video and you're still here, then congratulations and welcome to the family here. Okay, so thanks for watching, and I will see you in the next one. I'm going to be recording from a different location for the next day or two, and hopefully we can get some good images that look a little different from the different location to kind of spice things up for you. All right, so thanks for watching, and I'll see you in the next one.